Every founder myth has a beautiful camera angle. We see a chemical engineer who mortgaged his house, bought boring industrial assets, and built a company that touches everything, while almost nobody can explain what it actually does. It is a brilliant story. But the interesting thing about brilliant stories is not what they show. It is what they crop out. We are going to peel back the layers of the INEOS success story, looking beyond the headlines to the underlying mechanics. We will examine how a company built on aggressive acquisitions and leverage navigates the shifting tides of the global economy. Let's start with the carefully curated narrative. The flattering version of the founder's story is very seductive, full of humble origins, technical savvy, and a scary first deal. INEOS began in 1998 with an acquisition from BP Chemicals, and the official history leans into that origin story. The social media version says, "Not software, not hype, just chemistry and nerve." And honestly, that is a better story than yet another app founder explaining how they disrupted breakfast. But even here, the clue is in the caption: chemicals, courage, and debt. In a boom, debt looks like confidence wearing a tailored suit. In a downturn, it walks back into the room as the bill. So while the hero narrative is compelling, it is also incomplete. We need to look at the engine that powered this growth. The founder did not become interesting because he was loud. He became interesting because he understood a quiet industrial game. INEOS bought assets from giants like BP, BASF, ICI, and Dow, often in corners of the chemicals world that consumers never see but modern life cannot avoid. Think plastics, solvents, polymers, the invisible plumbing of consumption. The genius was not just buying boring things. The genius was buying them with a structure that could move fast, stay private, and use borrowed money as acceleration. That is not evil, that is business. But it is also not magic. It is a machine, and machines behave differently when the weather changes. And the weather, my friends, is changing. The current anxiety around INEOS is not best understood as one person suddenly getting unlucky. It is more interesting than that. European chemicals have been squeezed by expensive energy, weak demand, regulatory costs, and a wave of global capacity, especially from China. Credit rating agencies have pointed to high leverage, weak free cash flow, and downgrade pressure. Recent reports about talks to sell parts of the business sit inside that bigger industrial weather system. This is the part of the story that success content hates, because the hero narrative prefers personality over physics. Commodity chemicals do not care about your knighthood. Refinancing does not care how many trophies the brand sits beside. The market reads the footnotes, and the footnotes are less flattering than the LinkedIn post. So the punchline is not that the founder was a fraud. That would be lazy, and frankly less entertaining. The sharper point is that the same ingredient can be sold as bravery in one decade and risk in the next. When money is cheap and demand is healthy, leverage looks like elite conviction. When the industry turns, it becomes an X-ray. That is why this story belongs on Business Undercurrent. We are not here to cancel the founder myth. We are here to turn it around, check the back, and read the little label that says, "Some assembly required, debt included." If you enjoy these less obvious business stories, like the video and subscribe to Business Undercurrent. The real drama is usually not in the press photo. It is in the balance sheet just outside the frame,